So whether or not you're actually a commercial property holder or if you hold multiple residential units, it's still, once you get to that certain unit count threshold, it still gets considered a commercial application. Depending on the institution, that can be anywhere from 3 to 5 units is kind of that cutoff where they decide that, we're no longer a, residential application. That's just somebody's investment property, regardless of whether or not it's held in a holding company.
Hello, everyone. Welcome to Bamboo, Vancouver's property management and investment podcast. This week, I have Josh from Ashdown Capital. We're going to touch in a bit on commercial mortgages because we spend a lot of time looking at residential, but also you can invest in commercial. So Josh is going to help us learn the high overviews, ins and outs.
Thanks.
So welcome to the show, man.
Yeah, thanks for having me.
Yeah. So I guess before we get into all the stuff, like what brought you to doing mortgages for commercial? Like, where were you before this?
Where did it all start? Yeah. Well, originally I started in banking through an associate program with Canadian Western.
Okay.
Starting off on the commercial side, they give you like a full lap of the entire bank where, you're working in every different department, getting an idea of how everything else works before specifically hunkering down and focusing on commercial after that.
Okay.
So, yeah, it was a great experience and a good way to kind of, see how a full bank functions.
Tip the toe in the water.
Yeah, exactly. And then after a few years working commercial, eventually I went and worked for a developer for a few years. So, went industry, so to speak.
Okay.
And then came back to brokering in the end of 2019, start of 2020.
Cool. Very cool. All right. Well, thanks for the background there. So I guess what are the primary differences when qualifying for a commercial mortgage versus residential? Because I know there's some differences between the two.
Yeah. And there's really a few different kinds of commercial property categories. Probably the single biggest one would be owner occupied versus third party rental.
Okay.
So whether or not you're actually a commercial property holder or if you hold multiple residential units, it's still, once you get to that certain unit count threshold, it still gets considered a commercial application. Depending on the institution, that can be anywhere from 3 to 5 units is kind of that cutoff where they decide that, we're no longer a residential application. That's just somebody's investment property, regardless of whether or not it's held in a holding company. This is now commercial. So for rental, everything, whether it's commercial, residential, is all based off the rental income generated from the property. So the two biggest qualifiers are going to be the leverage, how high you can go relative to the collateral that you're securing it against, and the cash flow from the rental income. In more recent years in Vancouver, with prices escalating as quickly as they have, rents can't really keep up to that.
Yeah, absolutely not.
Residential, a little quicker because there's a bit more turnover. Commercial, like a commercial zoned property, typically you're, minimum 5-year lease. A lot of the times, and the tenants have a tenant option to renew for 1 or 2 more 5-year terms.
So you parked for a while.
So you could have in Vancouver here, you could have a commercial building that's been leased for 14 years. They still have 1 year left on their lease. And the lease rate that they're paying is based on that historical rate. From 14 years ago that the landlord and the tenant thought would be a reasonable escalation. I think 14 years ago, I don't think people quite predicted what Vancouver real estate prices
do not think so. And
would do.
Did is full of it.
So I mean that typically is the case where a lot of rental properties, that the ability to service a loan off the rental almost always is limited by the cash flow, the rental income, rather than the leverage. Typically, leverage, they do about 75% max. But then you also need to service the loan at what banks refer to as a debt service coverage. Not to dive deep into ratios, I'm sure audience doesn't want to do that. But basically your ability to make your payments versus the money that you're making. So the money that you make from the property should be about 1.2 times what your payment is going to be. It's typical range.
Rough overview.
It can fluctuate. Some will go as aggressive as like 110. or, some may be, a property that they're a little bit more worried about. Maybe vacancy is a little higher and they might ask for like 1.3.
Okay.
So there's a little bit of fluctuation, depends on, a couple of different factors.
Yeah, absolutely. Now, with that, we were just talking about the rates and stuff like that. Typically, between commercial and residential, like, is there a rough and dirty there? Are they more expensive, less expensive?
I mean, usually the simplest way would just be to add 1%.
Okay.
From whatever the residential posted rate is, keeping in mind there's also still some variation for risk too, right? If it's a property that's in, a smaller town, or it's, vacancy. Yeah, vacancy is not as good, or, you may have more difficulty finding tenants for whatever reason.
Yeah.
Then obviously that's not an apples to apples comparison anymore, right? And there are other lenders out there that will do like they have a higher risk appetite, and they will do different transactions that, otherwise the banks or credit unions wouldn't.
Okay.
And so to compare it to that, you can get commercial that ranges all the way to, kind of the low teens.
Yeah.
But then vice versa, you can get it down to as low as, 1% more than the current posted residential rate.
Okay. So yeah, it's not, I guess it depends on the case.
Yeah, very much. Yeah. And I mean, it can vary a lot too, depending, like if it is that third party rental or if it's owner occupied.
Yeah.
Then you can also have, I mean, kind of the sky's the limit, if you will. So if you're a business that's operating from the space, it's much less dependent on what the property could yield as a rental, and much more dependent on what the business is doing for their bottom line.
Selves. Yeah.
Because I mean, technically it is a tenant, because typically you incorporate a holdco, like a holding company and an operating company. But there'll be, even if you're signing for both, there's typically still a binding lease agreement between the two, a guarantee from the operating company.
Yeah.
And that will allow the bank then to look at the operating business as the source of cash flow, which in almost every situation is better than third-party rental.
Yeah.
And that's just because the kind of backstop there is, if your business doesn't operate at least at a level that a third-party renter could be paying you in the space, why continue to operate there, right?
You're probably in trouble.
Yeah, you're probably at a stage. And you know what? It happens where you have bad years, but if it's recurring year over year, you get to a point where it's, well, maybe we wrap this up and we just rent it out to a third party.
Yeah.
So with that kind of backstop in place, it's almost always the case that a third party rental will not get you as much debt servicing, will not get you the same amount of income as owner occupied would. And therefore you're able to qualify typically for more under an owner occupied property.
Okay.
And we've seen the banks do this a lot recently too. Yeah. Like they'll promote like up to 85-90%.
Okay.
Which honestly sounds, it sounds like they're doing a leverage up to 85 or 90.
Yeah.
Which technically they are, because they're securing against the property, but it comes down to the operating business itself. And you can almost think of it more as still that 75 leverage. And then anything above that is almost just, yes, it's secured by the property, but it's being qualified on the cash flow of the business. So it's almost more of a business loan kind of premium that you're getting at that point in time.
Okay, that's good. Now, you did talk about looking at appetite for risk and all that. What are some of the additional risks that a commercial would probably consider over a residential for an investment?
I mean, a lot of the time when you're qualifying personally, it's, your credit score, the leverage on the property, and your personal income history.
Yeah.
But beyond maybe just an analysis of what industry you're in, on the residential side, the banks won't dive, into your employer's business, right? Yeah. So there's a bit, there's quite a bit more due diligence just to do specifically with your business on the owner-occupied side. Third-party rental, it really depends on what your tenants are doing. If they're a more standard business practice, that's, usually they're, run-of-the-mill. They're not going to dive into it too deep. But if it's something that, like, they could potentially have, harmful solvents on site, or they could, there may need to be some kind of environmental indemnity because they're worried about, what they're operating on the property, then that requires, additional layers of due diligence to get through.
Yeah, like would that be something along the lines of like a dry cleaners, for instance? Because I know that they use heavy stuff and can't.
Yeah, and that's one where historically hasn't been great. more recent years, the chemicals they're using are much better, but it still requires an outside consultant to come in to complete typically environmental stage 1, where they're going to review the site, review the historical use. If they think there's need be, then they'll recommend a stage 2, which is they'll actually go and take ground samples to see if there is actual contamination. If not, great. And then
preferable.
Yeah, the transaction typically goes through. If there is, there could be another third step where, they do an analysis of what the remediation would cost. And at that point, if the buyer is still interested, then they can kind of make that decision of, estimated remediations, X number of dollars. How about we renegotiate the purchase agreement to offset that?
That makes sense. Now with the, is there a higher down payment that's required? Because for people like first time buyers and stuff like that, you can get in at 5%. You need more, obviously, for commercial.
Yeah, and I mean, as much as you do typically see, like the industry standard is typically commercial will go up to 75%. Residential without CMHC will do 80%.
Yeah.
But on the commercial side, it's not that often that you can fully qualify for anything beyond the 75 anyway. Like I said, with Vancouver, with the market here, with how,
it's pretty expensive out there.
Yeah, you're not, your limiting factor is typically the cash flow. Okay. So the idea of 25 down, 30 down is, at that point, not really the factor that you need to consider. It's more can I debt service it, improve profitability to the bank? Yeah,
and I guess along with that, you touched on that projected income obviously plays a major factor in there. How does the financial profile differ between commercial and residential? As far as you said, there's a higher down payment and they're going through your business. What if you are starting the business? Like you're just coming out of the
that's a really good question. So on the commercial side, if you're trying to qualify based on a business that's owner occupied, typically you're looking at about 3 years minimum for financial history. Okay. They'll review the financial statements to see that you actually have that track record of debt servicing. Which, I mean, for most businesses starting off, you're typically starting operations, and then once you lease your first space, and then once you've kind of proven out your business model and profitability, then you're looking at purchases.
Okay.
Like it's not often that a lot of businesses will come in and say like, hey, I'm going to start this from scratch, and
and I need a brick and mortar.
I'm going to commit to a big place right off the bat to do it, right? So that typically is the kind of order of operations we see, where they'll lease a space. And that's where those 5-year renewals are nice, because they're the tenant option where they can decide, hey, after 5 years, are we at a point where we should be looking at our own space?
Yeah,
and
I got you.
Yeah, and we're like quite often, it's not the same as a pre-qual on the residential side, but we can give them a soft pre-qual just to say, listen, this is what the business has done thus far. If you guys think you're going to hit these metrics, and then that kind of gives them like a goal for the next few years, and also gives them time to start lining up before their next term renewal on their lease.
Yes.
Because, I mean, you're typically, like you'd know better than me, but you're typically giving notice, 6 months in advance of when your 5th year is up, if you're going to renew for your new extension.
Yeah. And the other thing too with that is, do you need a extension? Like on the residential side, after your fixed term, it just automatically falls to a month to month. On the commercial side, is that the case, or like does it need to get signed?
It can be very bank specific.
Okay.
Like the bank or credit union that has their own internal policy for it. Typically, like when you sign a 5-year on the residential side,
I was thinking about the actual rentals, but no, you renew your mortgage. Sorry.
Sorry.
I was going on the wrong tangent there for a second.
Yeah, sorry. So on the mortgage side, if you do a 5-year term, quite often they don't even ask for any annual review documents. They're not asking for your T1s on an annual basis. It's, the next time it comes up for maturity, that's when they do the next application.
Yeah, absolutely. And is that the same for the commercial or no?
No, on commercial every year.
Oh, they go.
So some rental properties, some institutions will do every 2 years, but more often than not, it's every year, especially if you're an operating business.
Okay.
Either 90 or 120 days after your fiscal year end, they'll request financial statements from your accountant, and they'll do an annual review, which doesn't necessarily have to line up with the renewal. Like your fiscal year end can be any months of the year, and you could purchase a property in September one year, but then you also have a year end in December.
Yeah.
So then come March, April, May, the annual review happens. And if it's the year that you have a renewal coming up in September, then they'll probably do the renewal at that point, qualify you for everything. But when it gets to the point where your term does mature, unless they're, politely asking you to take your business elsewhere, they probably have an idea of whether or not they're going to renew it. And they'll flip it into probably an open floating rate until you make the decision of, what term do you want to lock it into? And that's mostly just so they can keep collecting their monthly payment, and it doesn't lead to this like hard stop where payments aren't coming in. They're, trying to reach out to you.
Yeah.
But I would recommend don't get to that stage.
Yeah.
If you're, if you know your renewal is coming, bankers have all dealt with the head in the sand client that just, for whatever reason, they didn't have a good year. Something wasn't going great for them, and they choose to just kind of go radio silent.
Yeah,
as opposed to
never good in anything.
No, and instead of a proactive approach, this is the problem. What can we do to solve it? Yeah. Can we get the credit department on side with this beforehand? Can we, discuss feasible mitigation plans for the next 6 to 8 months? What are we going to do? But it's the ones that just kind of, disappear, that it's really hard for the account manager or a mortgage broker to come in and actually
do their job, basically.
Yeah. It's hard for me to talk on your behalf if you're not saying anything on your behalf, right? I need to know what the story is and what the turnaround is going to be.
Yeah, that's funny. It's the same thing with the property management side, that communication, you have a tenant who just disappears because they're afraid they're going to get in trouble or something like this. And it's like, if you communicate, we can find a solution. Example, not paying your rent on time or whatever. If your tenant calls and says, hey, I'm going to be late on the rent, or I can pay half and half in 2 weeks, I had too much Christmas, whatever.
Yeah.
Then you can work with them. But if you don't know, then I just have to
you're
not doing it.
Yeah, exactly. You don't know their employer was late on a paycheck, and it's not their fault. They're out in the cold as much.
Yeah, exactly.
Figuratively speaking, right?
Yeah, very figuratively.
You know what I mean? That they're kind of waiting on this, and it's not really their fault. It's beyond their control. Yeah. So then obviously there's, and just from a people perspective too, the sympathy you're going to show towards somebody like that is
absolutely,
as opposed to the, fifth phone call in 2 weeks, voicemail again, I wonder if this guy is, still in town even.
Yeah. So. Especially the fact that you're getting pissed off, right? It's like, dude, just talk to me, man.
Yeah.
So with the zoning regulations, does that impact the financing for commercial properties? Obviously you can't go and put a restaurant where it's heavy industrial. I understand that, but
nor would you really want to, right? No. The business case doesn't, nobody wants to go into the, manufacturing district to, go up for fine dining.
Exactly. Yeah. But then how does that impact the financing on it?
It can, I would say indirectly, yes. Typically an appraisal is going to reflect if the OCP shows that there is potential for higher density.
Yeah, so OCP is the city plan, correct?
Yes.
Yeah, official city plan is what it stands for. We just want to throw too much jargon.
Oh, gotcha.
What are you talking about?
Yeah, so when the city designates a certain neighborhood as higher density or commercial or whatever purpose they're designating this area, there's still a process to go through to have it actually land within that zoning. So you could have a commercial property that's in this higher density area, but you still need to apply for development permits to have it rezoned for the use that you're going to get a higher value out of. So you do quite often in appraisals, you'll see best use for a property. And if it's, not the current best use, you may see that the appraisal reflects something much higher than the actual property, just looking at it. Yeah. And that's where you see all those news articles where it's just this little, 1950s post-war bungalow in Vancouver just sold for $3 or $4 million, and it's a tear down, and it's like a house like this, and then you look at what $4 or $5 million will get you elsewhere. It's you're not really buying it for the house, the land underneath, and then it's part of an assembly or something that's obviously going to get whoever's rebuilding it a much better profit. That dollar value is worthwhile. But then you also see where the appraiser then will just kind of not even bother looking at, say, an income approach, because that post-war bungalow is
obviously coming down.
Yeah, and it's only 1,800 square feet, and it's, what are you going to lease it for? It's not going to be for nearly enough to justify your, 3 to 5 million purchase.
No.
Nor would it, be able to service a mortgage of that size, right? So, your appraiser's going to look at that and just say, you know what, we're going to do a direct comparison because this, is better suited for redevelopment and the best use, like the density for that area shows redevelopment. So why are we just going to look at this as like a standalone single family house anymore?
Yeah. That
so,
makes sense.
So that valuation factors into the qualifying.
Yeah.
Right. But there's no, as long as the property is being used for what it's currently zoned for, the banks and credit unions aren't looking at much beyond that.
Okay. So what are some of because we've been talking about the differences between residential and commercial, what are some of the biggest misconceptions that people have when transitioning from residential to commercial as an investment?
I think the single biggest one would be time, how much longer it takes for everything to get done. And a big part of that too is just the number of professionals involved.
Yeah.
I'd say at the very, very first stages, you're talking to a realtor. The second call should be to an accountant.
Yeah. To make sure
your structure. Am I doing this in a holding company, or are there a couple of partners involved? What's the structure? Do we all have different, like our long-term personal tax needs as well? Because if there's going to be partners, then you may want to have subsequent layers of holding companies. Okay. And again, I'm not a tax expert. Yeah. We will recommend that any client speaks to their accountant and their lawyers first to make sure that the structure fits. And then we will find a solution to the structure that they propose.
Okay.
And depending on how many people are involved, that can create added layers of ownership, holding companies. And beyond that, the accountant, the lawyer, the realtor, and ourselves at this point, we're already dealing with 4 professionals.
Yeah.
Add in an appraiser, add in if it needs an environmental firm. Depending on the age of the building, you're probably getting a building inspector at minimum. If it's an older building, then you might be getting a condition assessment report, or you may even be getting like an engineer structural report.
Okay.
As well. So, we're there already up to,
7 or 8 people that
different folks that have to, handle the ball at some point in time, right?
Yeah.
So, I never want to put like hard time frames on it, but I would imagine to get a subject removal from the time you sign to the time you get subject removal, I recommend clients like 6 to 8 weeks.
Yeah.
At this time of year, especially if it's going to be signing back right now, like we're right before the holidays.
Yeah.
Like I would just
slow down a little bit.
Yeah, the 2 weeks at the end of the year, I just wouldn't even count those as 2 weeks of that time.
Yeah, fair
right. So start to finish to actually close on the property, I would say 8 to 10 weeks.
Okay.
Like after the approval, you're probably still a few weeks then that the lawyers have to pay for documents. You may still be waiting on a few reports. I just wouldn't want to rush anything, because when you do start requesting rush, then everybody's going to charge like a rush turnaround on it, because they have to drop everything to do it. Right?
Absolutely, yeah. And then that'll start stacking up real fast.
Yes, exactly.
So now with the financing trends throughout BC and that, such as like retail and industrial and multifamily and all that, have you noticed any trends over the past, say, year? Like, because we're getting close to the end of the year, have you been seeing more of X or less of X, or things have changed, or as an overview trend?
Yeah, I will say that when rates took off, commercial real estate did slow down quite a bit.
Yeah. And
I think it was that they kind of had 3 bigger jumps. And as the first rate increase comes in, if you're somebody that's, got a pending purchase lined up, which, we had some clients that were, first rate increase, it's like, okay, cost of doing business.
Yeah.
Second one, okay. Third one, it's like, okay, I'm not going to remove subjects on this. The numbers just don't work anymore.
Yeah. And they kept on going.
Yeah, we're just going to call this one. The real problem was the folks that were already past subjects when these rates started escalating. And we did have some where they had been qualified for an amount, and then rates gone up enough that they could no longer qualify for the full amount.
Yeah. Right?
The bank or credit union wasn't going to pull the offer, but
they won't
suddenly you're going from, for simple math, if it's $1 million purchase, they said that we would do 700. And all of a sudden they're coming back saying only 6.
Yeah.
because that's what the new rates qualify for.
Mm-hmm.
So there was a couple times where, we had people call us up with that issue.
Yeah.
Right. Because at the end of the day, if you have the money, it's unfortunate that you're now only qualified for 6 and you got to throw 400,000 at your new purchase now instead of 300. But there was a couple folks that they had 300. They didn't have an extra 100 just kicking around for this. You know what I mean?
Don't.
Like, this is like something that they've been planning for years, and all of a sudden there was this gap, right? So
do they just wash their hands of that, or what happens in this case?
So those were cases where, like, where the other folks that were pre-subjects, that just kind of walked away and said, you know what, I'm not looking at this anymore.
Yeah, that's an easy one.
And I'll be honest, we lost a couple clients that way. Yeah. They said, you know what, in a couple of years we'll talk about it again, but for the time being, we're just gonna, put the idea of a new property on the shelf.
Yeah.
And then by the same token, we actually gained a couple of new clients where this was the situation, right? Where their institution had, qualified them, and then subjects, and then rates increased, and now all of a sudden we had to find options for them to close on this, for the original amount at higher rates, to make sure they save their deposit. So I will say that, from our perspective, we did lose some business from the rate escalation, but then we did find some other clients and be able to help them as well, right? Where they were in much more of a jam, right? Because they were stuck with a situation where their down payment or whatever their deposit portion has already been put up. They're now binding contract because they've removed subjects, and so
that can be a little bit of a problem, I guess. Hey,
yeah, a little bit, and a very, very stressful. But those are the folks that were obviously like the most tentative to it. Like we do have some transactions where you're kind of pushing people along to speed up the process, and those are the ones that are obviously like they recognize the situation that they're in and the speed that we have to turn things around. So they're good. A lot of good folks that just got, for reasons outside of their control, stuck in a bad situation.
Yeah, of course. Right? You just can't control what the government's going to do, right? What got me thinking about that was, is there a rate freeze? Like in residential, you can get pre-qualified. They hold the rate for, a couple months usually.
Yeah.
Is there that on the commercial side, or just sort of, it is what it is today? There might change.
Most often, no, there isn't. There can be, but there's a lot of stipulations around it. Mm-hmm. Some of the credit unions will lock in for, say, 30 days. Mm-hmm. They're not going to do the 90 or 120 that a lot of the residential lenders will do. But there's also ones where you can lock it in for a longer period of time, but it typically comes at a fee. Okay. Like they'll charge a fee up front, but more often it's typically for larger loans. Okay. And it basically acts like an option. Yeah. Like you're paying to have the right to enter into this lower rate. Okay. And then depending on how it's structured, it could be binding. Like that could just be the rate that you have to pay, even if rates come down. Mm-hmm. Or that could be, this is the rate that I'm going to take unless there's a better rate available at the day of funding. Okay. So
now with that, like, can you push for that? Or is that just sort of just per lender? It's
per lender. It really depends. The size of it is typically whether or not they're going to offer it, because they do have to go to their treasury department, and they will have to structure things differently on the treasury end in order to guarantee that rate. They'll typically offset it with something in the bond markets to offset their own exposure. Yeah. So if it's going to be for a smaller loan, it's really difficult for them to justify it. Mm-hmm. And then you're kind of paying pro rata, you're paying a lot more. Okay. Yeah. So you typically only see it on larger transactions, but it also depends on how far closing is too, right? Yeah. And then you run into the issues of, if it's a finished property, it's one thing, but if it's a, new build, mm-hmm. closing date can impact how long that rate commitment can actually be held for until it's booked. So, if the developer of a, commercial strata site, mm-hmm. Ends up having to push 3 months, and typically purchase agreements are written in their favor so they can. Of course. All of a sudden you might, pay for this option to freeze your rate. Yeah. Within this window of funding, but then all of a sudden, construction goes long and that lapses by the wayside. So, yeah, I typically advise against it unless there's like a very specific need. Mm-hmm. But there are, certain options like that available.
Yeah. And now we haven't talked about the differences with residential and commercial. So obviously we've all seen that residential has just gone up, 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 up. Does commercial typically follow that trend with residential, or is it kind of its own? universe.
It does, but it moves a little bit slower just based on, those longer term leases, right? And the volume of transactions, right? There's not as many, commercial transactions in a given time frame as there is residential.
Yeah, absolutely.
Yeah. And I mean, part of that too is just the idea that a house is for the same purpose, to live in, right?
Yeah.
Like any house, obviously, like some people are used to a certain, standard of living. But at the end of the day, a house, an apartment, a townhouse, they are a place to live, right? Yeah. That's the purpose. But on commercial, depending on your business, you can only use certain spaces, right? Yeah. Like you're a manufacturer, you're not going in like a retail unit in the middle of a strip mall next to a subway. Right. You know what I mean? Like nobody's going to allow heavy industrial manufacturing there, right? Yeah. So I mean, that's kind of the big thing too, is that not only is it a slightly thinner market than the residential side, but it's also much more segmented.
Okay, cool. So what are some of the biggest mistakes that owners or investors make when they're seeking a commercial mortgage?
I'd say time is, like, I know I kind of hit on this earlier, but time. I think timing is just the biggest thing, because a lot of folks will come over from residential and thinking like, I can get qualified in 2 weeks. Yeah. I can close this in 3, 4 total, right? And it's, I would be very impressed if somebody can turn something around start to finish in 6 weeks.
Yeah. Okay.
It's like an extremely quick turnaround on a commercial purchase.
Yeah.
Like
so just assume we are going to be at least 6 to 8 minimum, right?
Yeah. And it's just like I said, the number of professionals, the ability to qualify in a quick turnaround too. A lot of the banks and credit unions, are pretty swamped right now. Yeah. A lot of the credit departments and everything don't have the capacity for how many loans they're reviewing. Yeah. And whether that's existing loans that they have to do their annual reviews or new loans that are being onboarded. Okay. So there's, a lot of work on that side, and a lot of the time, things get left with credit for a couple weeks. Yeah. And it's just kind of outside of our control at that point, right? Where, there's no way for us to expedite it, and it, all depends on their manpower. So I just don't like to, overpromise and underdeliver on timing, just because there's so many folks that are, outside of my control, outside of the buyer's control.
Okay. Yeah. So I guess the follow-up, what advice would you give for the first time commercial buyers or developers to secure financing? Obviously timing would be one of them, but is there any other tips to help sort of expedite that? I mean, I'm assuming have your documents in order.
I would you need to have your books in order. Your latest financial statements, personal as well, because they will do a review of your personal finances, personal net worth, credit score. Okay. It's not the credit score doesn't have the same factor that it does on the personal side, but it definitely gets factored into the overall equation. Yeah. If you don't have a very favorable credit score, then some of the banks just won't even deal with you as a principal. Okay. But by the same token as well, there's personal net worth can factor into it, where it's ability to take on additional debt in a company that you're guaranteeing. Yeah. No institution wants to lend to a company whose owner is personally insolvent, for instance, right? Like you have to be in good standing because they know that you may need to inject money into the company or into the
keep it afloat for
property. Yeah, if something comes up, right? Whether that's like a major reno or like some kind of, pipe burst, if you're just a third party rental landlord, or if it's, an owner occupied business, stuff happens with business, right?
Yeah, absolutely. Like
you
COVID.
Need to, yeah, exactly. You need to have the means to either assist your business or, if business is tough, be able to have the personal means to support yourself in the interim. So, it's like I said, it's not the same as residential, where that's entirely what you're underwriting based off of, but it does still, factor in where if a transaction's kind of on the cusp of going either way, good personal net worth, good credit, those things can, definitely tip the transaction in your favor.
So if you had one piece of advice for someone looking to thrive in commercial real estate in Vancouver or greater Vancouver, what would it be?
I think patience with, the actual property search. I do know a lot of folks that like when they reach out to me, it's just on a pre-qual basis.
Yeah.
Like they'll give us a call before they've even put an offer in on the property, just to say like, okay, like if I'm going to go down this rabbit hole, all this due diligence here, like what am I going to need to put down for us to actually do this transaction? And we can give them that idea beforehand.
Okay.
And at that point in time, then they can, with a bit more confidence, we still always recommend subject to financing and still do the full same structure.
Yeah, it's standard in the residential.
Yeah, exactly.
Never know.
But we can give them an idea of what they're going to qualify for.
Yeah.
So that then they can go in more confidently in the negotiation. And sometimes there are certain terms or certain particulars to a property that we know banks or credit unions are going to want certain things. So if we know that in advance, then they can ask from the buyer, or sorry, they can ask from the seller, and then have those documents in hand, as opposed to signing an agreement and then coming back and saying like, oh, do you have this? Do you have this? Do you have this? Like these added due diligence items, which, I mean, at that point in time, the buyer, unless they're going to fork up the money for their own all new reports, if the vendor's already completed half the reports as part of their marketing package, then you're, saving a lot of money by utilizing those instead.
Yeah, absolutely. Right.
Yeah.
Okay. So basically be patient, know that it's going to take some time.
Yeah. And be ready to shop around. Like, don't just, the kind of mentality of just first property that that they lock their eyes on, like this is the one, know. And I think business owners, compared to residential, there is a little bit more pragmatism, where they can look at things dispassionately, like, is this a good use for this space? Can we properly utilize this? Whereas you can see on the residential side, like, instances where certain part of a house or an apartment or something, you know what I mean?
Yeah, like emotion takes over.
Yeah, exactly. And I mean, hey, if you're gonna live your whole life or like a good part of your life in a certain place, and the two trees in the backyard like give you this like vibe from growing up when you were a kid.
Yeah.
You know what I mean? Like, that is an intangible that doesn't really factor into the price as much, but you enjoy that. You know what I mean? Personally. Whereas in like on the business side, you don't see that same value. It's more a by the numbers kind of calculation, which, I mean, for a business owner, it should be, right?
Absolutely. Numbers only. No
where you don't want the emotion to factor into it, where you might then start stretching for a property, going more than you would otherwise pay for it.
Yeah. Okay, well, that's cool. So if someone's trying to get a hold of you and find you to pick your brain on getting commercial mortgage, how do they find you?
So the easiest way to reach me would be an email.
Okay.
josh@ashdowncapital.ca.
Okay.
So our basic process is that, like I said, we would like to pre-qual clients before they put offers in. Quite often we don't get introduced until after they have.
Yeah.
Which, I mean, from our perspective, isn't a big deal. We can still arrange financing for them. But what we'll typically do is we'll review everything that they have on hand, put together an engagement of the terms that we'd be able to find them. Most often, I'd say about 80% of our transactions go to banks and credit unions, conventional lenders. Like, there's quite often, there's a market for alternative lending as well, like that other 20%, where, because of higher leverage or because of the existing cash flow that it has, where there may be an opportunity to go to those segments of the market for alternative lending. But the alternative lenders that we work with are ones that are looking for turnaround to conventional financing to the banks and credit unions. Okay. We're not placing clients with any kind of private lender where it's going to be a predatory situation.
Yeah.
What we look for and what those alternative lenders look for, and usually, one of the first one or two questions they'll ask is, how are we being paid out at the end of it? So, 12 to 24 months, how are we taking this client to a bank or credit union?
Yeah.
As opposed to...
they don't want to be holding it for the whole time.
They don't want to be holding it for, a long time. That's not really their, segment of the market. The idea is that this is a bridge transaction to get them where they want to go.
Okay.
And then that's, like I said, that's about the 20%. And then the 80%, the majority, the idea is that we're able to take it to the couple of institutions that are a best fit either for that particular property type, if it's owner occupied, that actual kind of business that's operating from that property.
Yeah.
And quite often that can just be I don't want to say flavor of the month, but it really depends on where institutions are at any given point in time with their existing portfolio of clients.
Okay. Yeah, so they sort of want to spread it around and not be just...
Yeah, and some do. Some are very good at certain industry segments, but you may find that, and especially like some clients will go to their house bank before they reach out to us to negotiate on their behalf. And when they do, the institution may come back and say like, yeah, we can't do this transaction. And it just kind of leaves them with a, is it me? Is it you? Like, why can't we do this transaction? You're like, it seems like a good deal to me.
Yeah.
And then little did they know that institution is already oversaturated. Their portfolio of loans already way too high a percentage for that given industry.
Okay.
Right? Which makes it difficult for them to do too much more without diversifying into other industries.
Yeah.
So for us, we do, like, our group has about 27 brokers now working with us, and our group, like, we keep our finger on the pulse of those kind of things.
Yeah.
Which institution is big in this space at this given point in time. And so then those become our first calls that we make.
Yeah.
And depending on the transaction, depending on how long they have to turn it around, we'll go to a couple of different institutions. And when we get the offers back from them, then we present all those to the client to make the decision on which one we want to go with.
Yeah. And you help guide them through that as well.
Yes.
Kind of like this is a plus here and a negative here. And...
Yeah, these are the terms that they're each laying out. These are the, the upsides to each. Quite often there will be one that's, kind of your outright winner.
Yeah.
But sometimes you do get ones where, okay, this rate is a little higher, but this loan amount that they're offering is slightly better.
Okay.
For the added interest expense of this, additional 100,000, this is how much more you're going to be paying on the entire amount. We'll do those calculations, the fee versus the rate.
Yeah.
You can have one that's a very big fee, but a very low rate, and vice versa.
Yeah.
And so we'll do those calculations to determine, which one your actually total dollars paid is more.
Yeah.
And that's another big difference from residential where, everything's on like a quoted APR. So it's easy to compare apples to apples.
Yeah, absolutely.
It's just the rate, this one's less than that, you're paying less. But on commercial, there are fees involved, and it's not at all a way to be, manipulative or anything like that. It is the added expense of the amount of work that it takes for the institution to complete the application.
Okay.
So quite often that will just be like the work fee at the onset. And I mean, a big part of that too is that fee is deposit based. So if the institution can't deliver, then it's refunded. Or if they can, then for some reason the transaction falls through for reasons outside the lender's control.
Yeah.
They're still compensated. Their staff are still paid for their time, right?
You.
Which, it's a check and balance, but it's, as long as you recognize that there is a give and take between the rate and the fee, then you're able to, recognize what the total dollars are that you're actually paying.
All right. Well, wicked. Well, thank you very much for coming on the show and giving us a high overview. We will have all your information, obviously, in the description below, so you'll be able to call and pick your brain deeper, because there are, as we've just learned, a lot of moving parts to commercial, more than there are on the residential side, obviously. So thank you very much for coming on the show. We really appreciate it.
Yeah, thanks for having me.
Cool. Thank you for listening. If you've listened this long, this has been Bamboo, Vancouver's Property Management and Investment Podcast.